Hi guys, Jared Johnson with Day Traders FX here again. Let's talk a little bit more about option trading. Now, in the video just before this, we talked about some of the very basics. What is option trading? Calls and puts, right? We discussed some of these details right here, and we said, here's a little bit of the basics about calls and puts. We have strike prices, we have expirations, some of the basics, right? Let's get into a little bit more detail about these calls and puts, how all of this stuff is going to work, because option trading again is just a process of putting calls and puts together in different orders and understanding kind of the basics that surround those to create an option trading strategy, right? How can we always have to kind of make a choice of do we want to take more risk and potentially make more money? Do we want to take less risk and potentially make less money? What are the things that we want to do? So we talked all about this right here. And we talked about these expiration dates, these strike prices, and again, we just have calls and puts. If we think the market is going to go up, we're going to buy a call option. If we think the market's going to go down, we're going to buy a put option. If we buy a call option, it goes up, we make a bunch of money, right? Let's say you buy a call option on Facebook and they announce that they've cured cancer or coronavirus or whatever, and Facebook stock goes from wherever it's currently trading and it goes up 100%. Your call option is going to be a huge profit, right? Or let's say that whatever their company out there that somebody hates, right? let's say that the airlines, for example, the airlines get shut down because nobody can travel for 2 years. Airline stocks are going to tank. Now, if we own a put option, if we have purchased a put option on an airline and the airline drops because nobody can travel for 2 years, we're going to make a ton of money on that put option. So just a little reminder, we have expiration dates, so we're always thinking about options with expiration dates because every option has one, and strike prices, right? Where is the area that we are starting this trade and where is that potential zone that our option is in the money or out of the money, where we might be able to just take ownership of the stock? We'll talk more about that. But let's talk a little bit about in option trading. Let's talk a little bit about this concept right here. Here's a call option. Here's Southwest Airlines. Here's a 40-day expiration. You can see January 15th, 40-day expiration. If I think Southwest Airlines is going to go up, I might buy a $45 option, right? Just a little bit. I'm going to go just a little bit below where the stock is currently trading, and I'm going to buy that call option. It's going to cost me a couple of bucks, about $425, $430, $40, somewhere in there. But I get to control 100 shares of Southwest Airlines. That's certainly a lot cheaper than paying the $4,750 that it would cost me to buy 100 shares. So that would be buying a call option. Now, as you can see right here, my broker platform allows me to click on this, see where my mouse is right here, and change it from buy to sell. What in the world does that mean? Buying an option, selling an option. Can I sell an option? Why is that a first step? How do I sell an option that I don't own? Let's talk about that. The responsibility of a broker, now brokers can do a couple of different things. Some brokers provide liquidity and do different things, but for the most part, what a broker is doing is they're connecting buyers and sellers, right? That's what a broker is. I mean, if you think about the term broker, then a broker connects buyers and sellers. A real estate broker doesn't necessarily own the house. Sure, he or she can, but typically a real estate broker does not own the house. What the real estate broker is doing is they say, hey, I have somebody here that wants to sell a house. Hey, I have somebody here that wants to buy a house. Let me connect these two people. That's what stockbrokers do and option brokers. They find buyers and sellers. So what we end up with is a situation where we have buyers and sellers. Whoops, there we go. We have pools of buyers and sellers, right? Pools of buyers and sellers. So here's our sellers pool, here's our buyers pool. And the broker is just helping connect us to either of those. Hey, you want to sell an option? I'll connect you with the buyers. You want to buy an option? I'll connect you with the sellers, right? That's all a broker's doing. So when we are given the opportunity to buy a call option or sell a call option, we're just taking one side or the other. If I want to be an option buyer, there are certain criteria that apply to buying options. If I want to be an option seller, there are certain criteria that apply to being an option seller, right? And I want everybody to kind of take away the typical definitions or thoughts that we have about buying and selling something. This isn't like, hey, I own a car and I want to sell a car to you because I own the car. But how could I sell you the car if I don't own this car, right? Take all of that out of your mind, because options are very finite things. They last for the amount of time from today till expiration. If you buy an option that expires in a week, that option will no longer exist whatsoever in 1 week. It will cease to exist. So we never really own an option. We buy options, which is basically making a placeholder kind of a bet, right? We don't own these options because they will cease to exist. You don't own an option any more than you own a banana. Yes, I own a banana, but this banana is going to not exist in a very short amount of time. So that is an important concept, right? So what I want you to think about when it comes to buyers and sellers is more use the term like long an option and short an option. For those of you that have any trading experience, you know that when we're long, like a currency contract, for example, if you're long a contract on the euro dollar, you want the euro dollar to go up. If you're short a contract on euro dollar, you want the euro dollar to go down. It's no different from option trading. If I'm long a call option, I want the stock that I'm buying to go up. If I'm short a call option, I want the stock that I'm looking at to go down, right? Why do we have both of those? Let's talk about that. So if I buy this call option, if I buy to open or I'm long this call option, I want the stock to go up. I want it to go up as high as it can go in the amount of time that I'm holding it, which is about 40 days. If I'm short this call option, I actually want the stock to go down. Now, it's different because then you might be saying, well, why in the heck would why do put options even exist? If I can be long a call or short a call, why would they exist? And we can also be long a put or short a put. So why do those things exist? Let's talk a little bit about that. So here are some details over here. I have a few written out instructions that I think will be helpful to look at. Okay. So if I am an option buyer or I'm long an option, and that's, I'm going to put that in there because I think that's important. Long, right? I'm long the option. Or I'm an option seller and I'm short the option. What does all that mean? So if I buy a call option because I think a stock is going to go up, I think, hey, the airlines are ready to go crazy. I'm going to buy options on such and such airline because I think it's going to go up. Here are the criteria that apply to this. And here are the reasons that I might want to be long a call option versus short a call option, or buy to open and sell to open. If I buy a call option or I'm long, I literally have unlimited profit potential. Now, it's unlimited for the time that I have that option. From today, when I bought that call option, to expiration. Expiration might be 1 week out, it might be 1 month out, it might be 1 year out. So it's unlimited for the time that the option is valid before expiration. And I have limited risk. So if, for example, I buy this option contract on Southwest Airlines and it cost me the $45 strike price, and it cost me about $420 or $30, I can't lose any more than $420 or $30, whatever I paid for it. Let's say I paid $430 for this option contract. I can't lose any more than $430. I can't lose any more than I paid for it. And that's good, because some of us that have traded currencies or other types of futures, you can certainly lose a lot of money with something going against you semi-eternally, right? If you get in the wrong direction and something goes against you and against you and against you and against you and against you, you can definitely lose a lot of money. Options, all you can lose is what you paid for it. So my risk is limited. If I paid $100 for an option contract, I cannot lose more than $100. That's it. So that's pretty good. Now, this is what is so appealing about buying, buying options, right? These first two things, unlimited profit potential, limited risk. And these are the reasons why we buy options or why we're long option contracts. But the challenging part, and there's no free lunch in any kind of trading, certainly not in option trading, the challenging part is this right here. Let me clear out some of this stuff. The challenging part is the next two items, right? Which is this right here. So part two of being an option buyer is we have these things that are working against us. We talked about unlimited profit potential, awesome. Limited risk, awesome. But market needs to move big, right? And let me explain why that is. And that's largely in part because time is working against us. So this is the non-appealing part about being an option buyer. This is kind of like the difference of earning interest versus paying interest. It's like using your credit card for everything and then paying it down slowly. You're just paying interest the whole time, and it's a huge bummer. Whereas earning interest, you're making money 24 hours a day. You're earning interest, and so that's the difference from being an option buyer and an option seller. If you here is a little diagram of these two things here. Let's say that you buy some Southwest, you buy a call option on Southwest Airlines right here. You buy this strike price, $43 and whatever. And you do this 2 months ago, right? And let's say that Southwest goes like this. What is going to happen is, because the stock is not increasing in value, therefore the option cannot increase in value, you're going to be getting eaten up by time decay. And time decay basically says, guess what? Right here, this vertical line, this is your expiration. A lot of people want this option that expires over here. A lot of people want this option here. Lesser people want this option here. Almost nobody wants the option here. Does that make sense? So when there's 3 months left to expiration, that option's got a lot of potential value to it, right? It's got a lot of potential value. When there's 3 days left, there's not a lot of potential value. What's the likelihood that a stock's going to make a huge run in the next 3 days? Pretty unlikely. What's the likelihood that it could make a big run in 3 months? Pretty likely. And so it's kind of like, going back to our banana example, I buy a banana on Monday, January 1st. Well, January 14th, 2 weeks later, chances are that banana is going to be a brown, mushy mess, right? Now, if I buy this banana and it's green over here on January 1st, and on January 14th it's a mushy, brown, disgusting mess, there's a lot of people that want to buy the banana over here, right? If this green, or if this brown, mushy banana was for sale at the grocery store, how many people would buy it? Probably zero. And that's just the same thing as our option trades. As that banana gets riper, rotten, totally worthless, nobody wants it over here. Everybody wants it over here, nobody wants it over here. It's the same thing with an option. Everybody wants it over here, nobody wants it over here when it's getting to that expiration. The only way that we can offset that major time decay is, and this is called time decay, right? This is this time decay situation that we're talking about. The only way we can offset that is by the market moving big. And this is this idea of the market needs to move big, right? So if the market moves big, then time decay is not such an issue. If I buy Southwest over here and the stock goes like this, yes, there's going to be some time decay, but the stock going higher and the value of that option increasing is going to offset that time decay. Maybe I'm losing 2 cents of value a day, but I'm gaining $1 of value a day with the stock moving in my direction. So that's a good thing, but that's also a bad thing, right? If the market doesn't move big, then my option's just going to get eaten up. It's going to lose more and more value the closer I get to expiration if the stock is not moving higher. If the stock is moving higher, no problem, we're good. Now, the challenge, as you can imagine there, is getting in at a time that a stock is moving and that the stock will move. How many times have you gotten into a trade and a stock did nothing for weeks or months. How many times have you been in a currency trade, a stock trade, an option trade, and the stock just did nothing for a month or two? Plenty of times. And so that's our risk, is that if the stock does nothing, our option basically just gets eaten up in time decay, in that value loss. So we need that option and that stock to move. So that's where we get being an option seller, right? So these two things are so appealing. We say, oh, I have unlimited profit potential, I have limited risk, except for the market needs to move big and time's working against me. If I'm an option seller, and this is the difference from buying a call option and selling a call option. If I'm an option seller, the first two sound less appealing, right? Limited risk, limited profit potential. That's not very fun. I'm a big gun. I want to make the big money. Now, certain amounts of option selling can come with big risk, but the way that we do it, we're going to be on the limited risk side of things. So we have limited risk, but we have limited profit potential. Why do we have limited profit potential? Because here is a call option. We're going to call this call option. Whoops, right here. So we're going to call this call option, and here is buy, and here buy. Hold on, we're going to say buy or long, and here is sell or short. Okay. So here's our call option, and so here's our buy long, right? That's this idea right here. And here is our sell, option seller or short, and that's all these details down here. Now the way that it works is if I'm an option buyer, I want it to go up and I can make a bunch of money, and as long as it does go up a bunch and increases in value, I've got this time working against me. Because I'm buying for a lower price, hoping to sell it for a higher price, and I have a limited window to do it in. When I'm an option seller, I'm actually getting paid to get into the trade. Now that might sound strange. When I'm an option buyer, I'm buying an option. Maybe I pay $100 for it, and I'm hoping to sell it for $200, right? And make some money on it. If I'm an option seller, I'm getting paid $100 to take this trade, and I'm hoping to get out for $0, meaning I get to keep all of my $100. This is my limited profit potential. Because over here, I'm buying a call option for $100, and if that stock goes up 1,000,000 times, my $100 investment could be worth $10,000. Over here, I'm an option seller, and I'm getting paid $100 to go into this, and I can't make more than $100. All I can do is keep all of my $100 or some of my $100, and that's where this limited profit potential comes from. And the way that that works is, if I'm an option seller, and I make $100, the option buyer pays $100 for the contract. The option seller receives that $100, right? The brokers get some spread in there. So maybe the buyer pays $100, the option seller makes $95, right? The broker keeps some money in the middle there. But pretty much all that money goes here. Now, what the option buyer wants to have happen is to have the stock go up. What the option seller wants to have happen is just have the stock stay below, the option stay below the strike price, or the stock stay below the strike price. So if I buy a call option that's a $43 strike price, if I'm the option seller here, all I care about is that that option stays below that $43 strike price. And that's where this stuff comes in and becomes a lot more appealing, right? So limited risk, limited profit potential, pretty boring, but guess what? Market does not need to move big. Time is working for me. And the reason that time is working for me is because I sell an option, and all it needs to do is stay below the strike price, because if it gets below that strike price and stays below that strike price at expiration, the option buyer is going to lose all of his money. If the option expires below the strike price for a call option, it is considered worthless. It has no value. For the option seller, I'm paid to get into this. I'm paid $100 to get into this. If that option expires worthless, I get to keep all my money. I don't have to buy my way out. If, on the other hand, this makes a big run up, the option seller is the one paying out the profits to the option buyer. Now, we have, of course, ways to offset that risk and so on, but that's how that works, right? I can't make more than $100 if I'm an option seller, but I have all these things. The more that option gets closer to expiration, the more value it loses, the better it is for me, because I was, as a seller or as a short on that call option, I was paid to get into that. And so as that loses value, if I was paid $100 for this call option, and this is our expiration date over here, and this option's just doing this, right? And the buyer is getting eaten up in that time decay. The seller is saying, yay, this is good. I was paid $100 over here. The option's worth $50 over here. It's worth $25 over here. So now, if it's worth $25, I at least have a guaranteed $75 as the option seller. And if it expires below the strike price, then I get to keep all the money because the option is worthless and I get to keep all my $100. So, most people, when they hear that concept the first time, it's quite complicated. And they talk, and you'll hear option trading videos and so on talk about insurance and I buy a house and it's worth this much. Those are all fine explanations, but this is what we need to understand, is that the difference between the two, being an option buyer is like hitting a home run. You have to hit it out of the park. The market's got to move big and it's got to move quick, right? And if it does, you make a lot of money. If I'm an option seller, the market doesn't need to move big and it doesn't need to move quick. This is like a base hit. This is like just getting on first base, right? It's much easier money to make, and I think everybody should be on the option selling side, but it is less money, right? And for a lot of people, that's less appealing. Everybody wants to make the big bucks and they want to be a millionaire trader instead of just making a lot of consistent profits. And this is how you make those consistent profits, is by selling options. We're going to talk a lot more about this, but I want you to start thinking about this and letting it kind of sink in a little bit, and I promise it'll be helpful for you. We'll continue to clarify this and how it works and how it goes. Hopefully that's helpful, everyone. More details to come. Thanks, guys.